Have you ever wondered how people make money trading currencies like the US dollar and euro? Welcome to Month 1, Forex Foundations, Day 1. Today, you're going to understand what Forex really is, how the market works, how to read your first chart, and how traders identify opportunities. By the end of this lesson, you'll look at a chart differently. Let's begin. Forex stands for foreign exchange. It's the global marketplace where currencies are bought and sold. The Forex market is the largest financial market in the world, with over $7 trillion traded daily. Currencies are traded in pairs, like EUR, USD, GBP, USD, USD, JPY. When you trade Forex, you are buying one currency, selling another at the same time. If you believe the euro will strengthen against the dollar, you buy AUD, USD. If you think it will fall, you sell AUD, USD. Simple concept, powerful opportunity. Now let's talk about charts, because charts tell the story of price. The most popular chart type is the candlestick chart. Each candle represents opening price, closing price, highest price, lowest price. Bullish candle. When price closes higher than it opened, usually green, shows buyers are in control. Bearish candle. When price closes lower than it opened, usually red, shows sellers are in control. Imagine this scenario on a EUR USD time frame. 1 hour price was at 1.100, buyers pushed it up to 1.1050. It closed strong and bullish. You would see a green candle with a small wick, strong upward momentum. Now imagine price reaches 1.1100 multiple times but keeps rejecting. That level becomes resistance. If price keeps bouncing from 1.0950, that becomes support. Here are 3 beginner truths. Price moves because of supply and demand. Markets move in trends: uptrend, downtrend, sideways. Structure matters more than indicators. Never trade randomly, always ask, is price trending? Where is support? Where is resistance? That's your foundation. Most new traders jump into trades without understanding structure, use too many indicators, risk too much money. Your goal in month 1 is not to get rich. Your goal is to build skill first, profits later. If you're serious about learning Forex the right way, rewatch this lesson, open a demo trading account, go to your charts and identify 1 support level, 1 resistance level, 1 bullish candle, 1 bearish candle. Drop done in the comments once you complete it. Tomorrow in Day 2, we'll break down market sessions, why London and New York matter, and when volatility is highest. This is just the beginning. Let's build your foundation the right way. See you in Day 2. Month 1, Forex Foundations, Day 2, Market Sessions, and Why Timing Matters. Welcome back to your Forex Foundations journey. Yesterday, you learned what Forex is and how to read candlestick charts. Today, we're talking about something just as important: market sessions and timing. The Forex market is open 24 hours a day, 5 days a week, but that doesn't mean it moves the same way all day. The market is divided into 4 major trading sessions: Sydney session, Tokyo session, London session, New York session. The 2 most important sessions are London, New York City. Why? Because this is where the largest financial institutions operate. When these sessions open, volume increases, and volume creates movement. Why sessions matter? During the Asian session, the market is often slower and ranges more. When London opens, volatility increases. This session often sets the daily trend. When New York opens, volatility increases again, especially during the London-New York overlap. This is usually the most active time of the day. More activity means bigger price moves, stronger breakouts, clearer trends, but it also means more risk. Chart example: imagine you're looking at GBP USD on the 1 hour chart. During the Asian session, price moves between 1.250 and 1.2520, small candles, no clear direction. This is called a range. Now London opens, price breaks above 1.2520 with a strong bullish candle and high momentum. That breakout shows new volume entering the market. Later, when New York opens, price continues pushing upward to 1.2580. This is how sessions create opportunity. Key lesson: not all hours are equal. Trading during low volume periods can lead to false breakouts, slow movement, frustration. Trading during high volume sessions can offer clearer structure, stronger trends, better setups. Smart traders don't just trade price, they trade time. Beginner tip: if you're new, focus on trading during the London session or the London-New York overlap. Avoid random late-night trades with no volatility. Consistency comes from structure and timing. Call to action: today's assignment. Open your chart. Mark the Asian session high and low. Watch what happens when London opens. Notice if price breaks out or continues ranging. Do this for the next 3 days. Tomorrow in day 3, we'll cover trend structure, how to identify higher highs, lower lows, and real market direction. You're building real trading awareness now. See you in day 3. Month 1, Forex Foundations. Day 3, Understanding Market Structure and Trends. Welcome back to Forex Foundations. In day 1, you learned about charts. In day 2, you learned about trading sessions. Today, we focus on one of the most important skills in trading: market structure. If you understand structure, you understand direction. What is market structure? Market structure is the pattern price creates as it moves. The market moves in 3 ways: uptrend, downtrend, sideways, or range. An uptrend forms when price creates higher highs and higher lows. This means buyers are in control. A downtrend forms when price creates lower highs and lower lows. This means sellers are in control. If price is not making clear higher highs or lower lows, it is ranging. Let's say you are analyzing OR USD on the 1-hour time frame. Price moves from 1.0800 to 1.0900, that's a higher high. Then it pulls back to 1.0850, but does not break the previous low. Then price pushes to 1.0950, another higher high. This pattern confirms an uptrend. Now imagine price fails to make a new high and instead drops below 1.0850. That break of structure could signal a potential trend change. Structure tells you when to look for buying opportunities, look for selling opportunities, or stay out of the market. Why structure is important? Many beginners rely heavily on indicators. But indicators follow price. Structure is price. If the market is in an uptrend, you should focus on buying pullbacks, not selling randomly. If the market is in a downtrend, you should focus on selling rallies, not buying blindly. Trading against structure increases risk. Trading with structure increases probability. Simple rule for beginners. Before entering any trade, ask, is the market trending or ranging? Where was the last higher high or lower low? Am I trading with the direction of structure? If you cannot answer these questions clearly, do not trade. Clarity creates confidence. Here's your task for today. Open your chart, choose one pair. Mark the last to higher highs and higher lows or lower highs and lower lows. Label the current market condition, uptrend, downtrend, or range. Do this on at least 2 timeframes. Tomorrow in day 4, we will cover risk management, the skill that protects your capital. Remember, structure first, strategy second, profits later. See you in day 4. Month 1, Forex Foundations. Day 4, Risk Management, protecting your capital. Welcome back to Forex Foundations. So far, you've learned about charts, sessions, and market structure. Today, we cover the skill that determines whether you survive in trading: risk management. You can have a great strategy, but without risk control, you will lose your account. What is risk management? Risk management means controlling how much money you risk on each trade. Professional traders do not focus on how much they can make, they focus on how much they can lose. A common beginner rule: risk only 1 to 2% of your account per trade. If you have a $1,000 account, 1% risk equals $10 per trade. 2% risk equals $20 per trade. This protects you from large losses, stop loss, and take profit. Every trade should have A stop loss, where you exit if the trade is wrong. A take profit, where you secure gains. Never enter a trade without a stop loss. Chart example. Let's say you are trading USD JPY on the 1-hour chart. The market is in an uptrend, higher highs, higher lows. Price pulls back to a support level at 150.00. You decide to buy. You place stop loss at 149.70 below support. Take profit at 150.60. This gives you a risk of 30 pips and a reward of 60 pips. That's a 1:2 to risk to reward ratio. This means if you risk $10, you aim to make $20. With proper risk management, you do not need to win every trade to grow your account. Why risk management matters. Without risk control, one bad trade can destroy weeks of progress. Emotional decisions increase, fear and greed take over. With risk control, losses are small. Confidence improves, consistency becomes possible. Trading is not about winning every time, it's about protecting capital while letting winners grow. Beginner rule to remember: before entering any trade, ask, where is my stop loss? How much am I risking? Is the reward worth the risk? If the reward is smaller than the risk, reconsider the trade. Discipline beats excitement. Call to action. Today's assignment: open your demo account, find one setup, calculate 1% risk. Place a trade with a clear stop loss, a clear take profit. At least a 1:2 to risk to reward ratio. Practice this 3 times. Tomorrow in day 5, we'll discuss trading psychology, how to control emotions and think like a professional trader. Remember, amateurs focus on profits. Professionals focus on risk. See you in day 5. Month 1, Forex Foundations, Day 5, Trading Psychology, Mastering Your Emotions. Welcome to Day 5 of Forex Foundations. You've learned about charts, sessions, market structure, and risk management. Today, we talk about the factor that separates beginners from professionals, trading psychology. Because in Forex, your biggest opponent is not the market, it's your emotions. Why psychology matters. Most traders don't lose because of strategy. They lose because of fear, greed, impatience, overconfidence. You can know exactly what to do and still fail if you can't control your emotions, the 2 dangerous emotions. 1. Fear. Fear causes you to close trades too early, avoid good setups, hesitate. 2. Greed. Greed causes you to overtrade, risk too much, remove your stop loss. Both can destroy your consistency. Chart example. Imagine you are trading USD on the 1-hour chart. You identify an uptrend, a pullback to support, a clear bullish candle. You enter the trade with 1% risk, a 1:2 to risk to reward ratio. Price moves slightly in profit, then pulls back a little. Fear tells you, close now before it reverses. You exit early. Minutes later, price hits your full take profit. That's emotional trading. Now imagine price moves strongly in profit. Greed tells you, don't close, let it run more. You remove your take profit. Price reverses and you lose again. Emotional trading. The market didn't fail you, discipline did. Professional mindset. Professional traders accept losses as part of the game, follow their plan, never move stop losses randomly, focus on long-term consistency. They understand one truth: you do not need to win every trade. You need to follow your system every time. Build psychological discipline. Here are 3 rules. Risk the same percentage every trade. Never trade without a plan. Stop trading after reaching your daily loss limit. Consistency in behavior creates consistency in results. Call to action. Today's assignment: open your journal. Write down your trading rules, your risk percentage, your daily loss limit. Then review your last 3 trades. Did you follow your plan or your emotions? Starting tomorrow, commit to discipline over excitement. See you in day 6.
Welcome back to Forex Foundations Day 6. Today, we're diving into one of the most important skills in trading: how to read a Forex chart and understand market structure. If you can read a chart correctly, you can understand what the market is doing and what it's likely to do next. What is a Forex chart? A Forex chart is simply a visual representation of price movement over time for a currency pair like your USD, GBP, USD, USD, JPY. The chart shows how buyers and sellers interact in the market. There are three main types of charts: line chart, bar chart, candlestick chart, which is the most popular and powerful. Today, we'll focus on candlestick charts. Understanding candlesticks. Each candlestick represents price movement within a specific time period. For example, 1 minute, 15 minutes, 1 hour, 1 day. Each candle has 4 key parts: open price, close price, high, low. If the candle closes above where it opened, it's bullish, meaning buyers won. If it closes below where it opened, it's bearish, meaning sellers won. Think of each candle as a mini battle between buyers and sellers. Chart example: basic uptrend structure. Imagine you are looking at the Your USD 1-hour chart. You notice this pattern. Price makes a high, pulls back slightly, makes a higher high, pulls back again, makes another higher high. This is called an uptrend. What defines an uptrend? Higher highs HH and higher lows HL. Visually, it looks like stairs going upward. Example structure: low gives high, gives higher, low gives higher high. This tells you buyers are in control. Downtrend structure. Now imagine price starts doing this. Makes a low, pulls back. Makes a lower low, pulls back, makes another lower low. This is a downtrend. What defines a downtrend? Lower lows LL and lower highs LH. Visually, it looks like stairs going downward. This tells you sellers are in control. Why market structure matters. Most beginners lose money because they trade against the trend. If the market is in a clear uptrend, look for buying opportunities. If the market is in a clear downtrend, look for selling opportunities. Trading with structure increases probability. Remember, the trend is your friend. Time frames matter. A key concept in Forex Foundations is this: the market can be in an uptrend on the 1-hour chart, but a downtrend on the 5-minute chart. That's why professional traders analyze multiple time frames before entering a trade. Start with a higher time frame to identify the trend, then a lower time frame to find entry. Beginner mistake to avoid: entering trades randomly without identifying trend, ignoring structure, or trading every candle. Instead, mark highs and lows, identify HHL, LLH, and wait for confirmation. Patience is a trading skill. Action step for today: open your trading platform. Choose a major pair like EUR/USD. Go to the 1-hour time frame. Mark the last 10 swing highs and lows. Ask yourself, is price making higher highs or lower lows? Practice this daily for 15 minutes. This builds chart reading skill faster than any indicator. Call to action: if this lesson helped you, comment Day 6 complete. Share this with someone learning Forex and follow for Day 7, Support and Resistance Foundations. Consistency builds skill. Skill builds confidence. Confidence builds profitability. See you in Day 7.
Welcome everyone, and welcome to Month 1, Forex Foundations. Today is Day 7, and we're going to break down the core fundamentals of Forex trading. We'll look at a real chart example, and explain how you can start analyzing the market with confidence. Let's get started. What is Forex? Forex, short for foreign exchange, is the global marketplace where currencies are bought and sold. Every time you trade Forex, you are buying one currency and selling another at the same time. These currencies are traded in pairs. For example, your USD GBP, USD USD, JPY. If you buy your USD, you believe the euro will strengthen against the US dollar. If you sell it, you believe the euro will weaken against the US dollar. The Forex market is the largest financial market in the world. operating 24 hours a day, 5 days a week. Key Forex concepts you must know. Before placing any trade, you must understand. Pips. A pip is the smallest price movement in a currency pair. Lot size. This determines how much you are trading. Leverage. Leverage allows you to control larger positions with smaller capital. But remember, it increases both profits and risk. Spread. This is the difference between the buy and sell price, essentially the broker's fee. Understanding these basics is the foundation of everything in Forex. Chart example. Reading the market. Now let's look at a chart example. Imagine we are analyzing your USD on a 1-hour time frame using a candlestick chart. You'll see green candles price moved up, red candles price moved down. Let's say price has been creating higher highs and higher lows. That tells us the market is in an uptrend. Now imagine price pulls back to a previous support level and forms a bullish engulfing candle. This tells buyers are stepping back into the market. That could be a potential buy opportunity. On the other hand, if price forms lower highs and lower lows, we're in a downtrend. If price retraces to resistance and forms a bearish rejection candle, that could signal a potential sell opportunity. The key takeaway: don't trade randomly, trade with structure, follow the trend. Why foundations matter. Most beginners lose money because they skip the basics. They jump into indicators. They follow signals blindly. They trade emotionally. But professionals focus on market structure, risk management, patience, discipline. Forex is not gambling. It's a skill. And like any skill, it requires strong foundations. Simple trading framework for beginners. Here's a simple structure you can follow. 1. Identify the trend. 2. Mark support and resistance. 3. Wait for confirmation. 4. Manage your risk. Never risk more than 1 to 2% per trade. 5. Execute with discipline. If you master just these 5 steps, you're already ahead of most beginners. Call to action. If you found this lesson valuable, like this video, comment foundation below. Share this with someone who wants to learn Forex. Follow for day 8 of our Forex journey. And if you're serious about becoming consistently profitable, stay committed to this month 1 foundation series. We're building real traders step by step. See you in the next lesson.